Each month, I pound cost average into low-fee index funds to achieve the long-term benefits of compound interest. I swear to you, by the end of this video, you'll know exactly what all of that means. Hi everyone, and welcome to this new video, and welcome to Creative Money. In this video, I want to show you exactly how you can invest into ETFs and how you can start with a beginner's investment strategy to start making money on your money. I'm going to be giving you an introduction to my own investment strategy and how it can work for the average or beginner investor. If you don't want to be spending a lot of time looking over charts and being on your laptop all day, then this might be a strategy for you, because I don't know about you, but I would rather be out enjoying myself and knowing that I've got a passive investment that is making money on my money. For myself, I've been traveling the world for the past 5 years, earning a passive income and enjoying my time outside, knowing that at least I have some investments that are achieving returns for me. And to explain how that works, I've got to take a little bit of a step back.
I directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
Bear with me. In 1971, Nixon took the USA off the gold standard. And you might have heard about this before, you might have heard the term gold standard. I'm going to say exactly why it's relevant to us right now in 2020. Before that time, it meant that paper money, the US dollar, had an exact monetary value in gold. You could transfer your money back to gold and it always had that equivalent value in an amount of gold. I mean, in other words, real world gold backed the value of money. So in 1971, the value of gold was around £18 per ounce. That's 18 GBP per ounce, or roughly 44 US dollars per ounce of gold. In 2020, the value of that same ounce of gold is £1,350 per ounce, or roughly $1,700. So now, what's changed in those 50 years? Has the amount of gold changed? The amount of gold is still an ounce. The ounce of gold in 1971 is still an ounce of gold in 2020. So let me ask you, has the gold become more valuable, or has the value of the dollar or the value of the pound decreased? Now I'm going to try and explain why this is important. Because let's say you had that £18 in 1971 and you kept that in cash, your 18 pounds sterling or your 44 USD. And I'm going to continue with pounds for the rest of this. Let's say you had invested that £18 in a savings account at 1% and just continually earned 1%, which is also quite a generous rate over the long term for an average savings account. That would be worth about £30. Had you taken that £18 and invested it into gold, that £18 you invested into gold, which is still the same amount of gold in those 50 years, is now worth £1,350. So with that, hopefully you can kind of understand the value of investing over just setting your money aside. If you just put your money aside, sure, it's there available for you, and I think people should have a bit of a runway and a bit of savings for a rainy day. But if it's just sat there, it's not working for you. There are ways instead that you can invest your money and you can put it into certain things to make your money work for you. Now I wanted to share that example first because it kind of blew my mind when I first heard it, but now I'm going to get into the different ways that you can achieve some return on your money, because that play with gold would be amazing. That's like a 3,600% return, which would be very, very good. But I'm going to show you how you don't need to achieve that kind of crazy return to still make some pretty crazy money, even if you over the long term. Even if you can achieve a 10% per year, and 10% would be great, using the power of compound interest and diversifying your investment through ETFs, which is what I'm going to talk about right now, then you can actually achieve some pretty amazing returns completely passively. The truth is that for the average investor, Achieving returns like that is only possible in hindsight. It's much better to diversify your investments and gain an average return over each year and use the power of compound interest. Now, who is it? I'm going to search it right now. One sec. There's this great quote. Compound interest is the eighth wonder of the world. And it's attributed to Einstein. I'm not exactly sure if it was Einstein. He who understands it earns it, and he who doesn't pays it. And rather than me explaining in depth what compound interest is, let me just show you what would happen if you invested $100 each month from the time you were 18 until the time you were 60 and managed to achieve a 5% and a 10% return. Okay, so let's do this. I'm going to show you right now. So let's say your initial investment is $100. So all you're going to do is start putting away $100. And this is based on if you are 18 right now. And I'll do another one afterwards. $100 at 10%. And then you put away an extra $100 every month for, let's go for until you're 60. So over 42 years, and that will compound, so you'll get 10% on your 10% on your 10% every year, starting today, because there is no better time to start them right now. That $100 a month would be worth, when you're 60, $700,000 from just $100 a month. You don't even need to do anything that special for this. I mean, the average market return of the FTSE 100 for the last 25 years was 6.4%. So if you only achieve, people say it is very difficult to beat the market in the long term. So let's say if you just achieve the market return of 6.4%, and that would be just investing in the market. So there are index trackers where you can just put your money into the market and it will just track the market. You don't have to do anything special. It will track the market and you'll always get the market return, which here is 6.4%. So let's change it back to that and see what happens. This is the minimum. If you just did that, this is what you could get. $250,000 from just putting away $100 a month. And that's how much it can stack up. Now, if you manage to do the same with $200 when you're 18 and invest it for 42 years until you're 60, at the average rate of return, you'd end up with $500,000. And now this can change exponentially. If you manage to make 10% a year, which is a reasonable aim, if you can manage to make 10% a year and you can put away $200 a month, you would end up as a millionaire. You don't have to come up with the next crazy, amazing invention or innovation. You don't have to start a big business. You just have to be smart with your money to be a millionaire. Now, obviously, most people when they're 18 aren't thinking about this sort of thing. I know I wasn't. I'm 29 right now. So let's change that instead. I'm still going to base it on the fact that I'll be 60, or let's say 65. No, I'll keep it 60. That's the same. I'll base it on the fact that I'm 60. So that would be 31 years from now, putting 200 away each month. That would be $460,000 just from putting that away. And that assumes I'm not making any more. That assumes that I'm not increasing my investment, which I would be trying to do. What I am doing right now personally is putting away $500 a month. So if that was $500 a month for the next 31 years, then eventually that would come out as $1 million. Now that $100 per month isn't that unreasonable. If you manage to save a lot more, and if you manage to put away $200 a month from the time you're 18, or let's say whatever age you are right now, you can go and search, and there's a whole bunch of compound interest calculators all over. Just search for it in Google, and you'll be amazed at the returns you can get just by putting in an extra $100 or $200 per month and pound cost averaging into your investments. The most important part of this is that you're always making money on your money. So if I'm investing $200 one month, and then let's say that goes up 10%, that's $220. I'm then making 10% on that $220. So the next month that's $240, but I've also added another $200 to it. So that's $440. And then another $200 on top of that. So 10% of that would be 484 plus another 200, 684 to then make 10% on that. And it always keeps going on top. It always keeps compounding. So this is how it really stacks up in a relatively short time. The earlier you start, the more you're going to take advantage of it. But if you can start right now, the best time to start is always right now. Well, the best time is yesterday. I love quotes. The best time to start investing was 20 years ago. The second best time is right now.
Yesterday, you said tomorrow. So just do it! Make your dreams come true!
I'm gonna hit you with one more quote. It's not timing the market, it's the time in the market. If you dollar cost average in, or if you pound cost average in, then you're always getting the best price over the long term. Because even if there's a crash, and there was a big crash last month, there's potentially another big crash looming around the corner. A lot of people are saying that this isn't over yet because of the whole situation we're in. There could be another crash. But as long as I'm buying in next month and the month after, even if the market keeps going down, I'm still getting the best price for the long term. Because in the long term, markets do always go up, or traditionally they have, and that's all we can base it on. So in the long term, over the next 20, 30, 40 years, which is what I'm thinking, I'm in it for the long term, then markets will eventually go up. So as long as you're always pound cost averaging in, you're always getting the best price, and you're always going to continue making money on your money. It's also a way of doing it that is completely passive. I don't have to pick and choose. I don't have to have the anxiety of deciding when to buy and sell. These funds that I'm choosing to put into, and I'll do more on this in the future, are different funds that are actively managed by other people to pick and choose the stocks that they think are going to perform the best in the sectors they're in. For example, for myself right now, I'm putting into Japan, emerging markets, UK, USA, sustainable energy, gold, and I'd have to look, but off the top of my head, those are the different funds that I'm putting only £50 a month into each of them, or I mean, when I can as well, I try and up that to other amounts per month, but I'm always trying to pound cost average in to get the returns over the longer term. This is another point that I can get into more in the future as well, but you should also be diversifying into different sectors and different countries. So the reason I've chosen those different sectors, which my portfolio would also have more than that, is because then you're not at risk of only one country or of only one sector having a massive crash. If you're well diversified between both, within stocks and shares, but also in other investments where you can, then you're always going to achieve that return over the long term. Now, I want to say, I am fairly new to this. I've only been doing it for the last couple of years, and I'm trying to share the information with you and make it digestible in a way that is relatable to someone that's starting out, because I'm relatively new to this and I'm learning as I go. So what I would always say in all of these videos is make sure to go and do your own research after this, and make sure and go and research what works for you, what your level of risk is, how much you want to put aside, and how much you want to be involved in this. Because I would say, if you're going to do it, then make sure you understand it as much as you can. Now, if you are interested, I use a couple of platforms. For me, it's Nutmeg and Hargreaves Lansdown. Nutmeg is fairly easy to use. You can just sign up. It is within the UK. You can sign up and then you can allocate your level of risk, and then they will manage your portfolio for you. So you can average your money in each month, and someone will decide what to invest in and how they can get the best return for you. And the way I see it is, these are people that are working full-time to make the most out of the current market situation. If I had the time and the training to maybe sit there on the laptop all day and research the best stocks and equities and markets to be in, then maybe I could compete with these guys. And I mean, I also do dabble in other investments, but the best way to make it work for you in the long term, in my opinion, is to take advantage of these funds and these companies that will manage that for you. And now this is a very passive way of investing, because you can just put it in there monthly and have someone else do the work. you do want to make sure the fees are quite low. So whenever you are selecting a fund, or whenever you're selecting a fund manager or a company, check their fees and make sure that you're not getting eaten up in fees. Because if you are wanting to make 10% a year, for example, to take advantage of the compound interest returns, then you don't want 3% of that to be lost in fees, because then you need to be making 13% a year. Or let's say that you have a particularly bad year and you only achieve 4%, well, 3% of that was fees, so you're now only making 1%. It is definitely something that's worth looking at. I actually say as well, it's completely free, but if you go on Audible and look up Unshakable by Tony Robbins, it's a great 1-hour audiobook, and they go through this in depth. Really good to listen to. I listened to it a couple years ago, and it sort of it solidified what I was already thinking about passive investments and compound interest. So I definitely recommend that. If you're also interested in Nutmeg, I'll put the link below. They are who I am recommending right now. I know they've also been recommended by Martin Lewis and the Money Saving Expert. You also get 6 months of no fees if you use that link, and then I also get a kickback for it as well. So it is an affiliate link, just FYI. I said at the beginning of the video that you would understand that sentence, that each month I pound cost average into low fee funds to achieve compound interest. And I hope this video has cleared that up. So let's break it down. Pound cost or dollar cost averaging is just continually putting your money in over a period to get the best long-term price. If you're always averaging in, then you will get the best price over the long term. It doesn't need to be every month, but you keep averaging in over different intervals. Usually it's monthly. Low fee funds. Now, funds are great because they can manage your investments for you, but make sure the management fee isn't taking up too much of your returns. And long-term benefits from compound interest, I invite you to go and search for compound interest calculators, because just have a play around with it, because that is how you will see, and that's what really opened my mind to it. But hopefully this video has introduced you to the idea of how you can make compound interest work for you. Thanks for watching. I hope you enjoyed it. This massive disclaimer that I am always learning, and I'm going to continually share as I'm learning, and hopefully we can continue to grow and learn together. For now, thank you for watching, and see you in the next one.